And we are back on this big national figure on the screens right now, talking about Ghana's debt stock actually rising by some 71.6 billion Ghana cedis within just 3 months. And when we put out this story, we've had a number of, questions and debate around this number and how we were even able to arrive here in terms of racking up such a huge amount of debt in just 3 months. This afternoon, we are going to break this down for you, give you more context as to why you see this figure on the smart wall. And as usual, Caleb Ziblim is here to help me with the analysis. And Caleb, we start from this big figure. That was the figure we're reporting this week, that within a span of 3 months, and when we say 3 months, we are talking about between July and September, or the second and third quarter of 2025, Ghana's debt stock rose by some 71.6, or roughly it's about 72 billion cedis. And there were a lot of questions there, a lot of questions have been raised, debate on the internet, people trying to understand why we are here currently, because they recall that the finance minister made an important statement when he was reading the mid-year budget of 2025, where he said that if you look at the prudent management of the economy and as well as the discipline and the management of the exchange rate situation, they have been able to bring down the debts from 726.7 billion cedis to about 613, which when we did the math was around 150 billion Ghana cedis. Now, fast forward, two quarters or a quarter after he had read this budget, we are beginning to see the story change. The most important thing that I want us to do here on the show is to help people understand why we are recording this huge figure. In fact, let's go back to that 71.6 billion cedis. How did that happen? What were some of the big factors that resulted in this big figure that we are seeing in terms of the amount of monies we've added to our debt stock within this short period, Caleb?
Okay, so to understand why it has gone up by 70 billion, is to understand how our public debt is made up.
Yeah.
So it's composed of external debt and domestic debt. So the external debt is mainly priced in dollars.
Yeah.
Because you go out and borrow money, and usually it's in dollars. Sometimes the Chinese yuan and all of that coming, but then mainly dollars. So you have your external debt in dollars, but then your domestic debt, that's from the T-bill market and then sometimes the bonds markets. It's still active, even though the DDP messes around a bit. So from your domestic side, you borrow in cedis. From external side, you borrow mainly dollars or the euro or any other reserve currency. And we are seeing this rise because of the exchange rate factor. And we'll get into how the BOG is managing the exchange rate and all of that. But then once you convert how much you owe the people or your external creditors into cedis, that's where you see your domestic, your total debt going up or down. So if earlier this year we saw exchange was around 14 cedis, 70 pesos.
Yeah.
If you convert your external debt, which is in dollars, but you're still paying cedis, because and also people have to understand that when you're paying your external debt, it's government that pays your external debt, not the central bank. Central bank does not pay the debt.
Not at all.
So once the government goes to pay the debt, the government takes cedis to the central bank gives them dollars
to go
and they pay it. So if the exchange rate is favorable, the government will take less cedis to the central bank, and there's enough cedis left for roads and all of that, and then they pay the external creditors. So once your exchange rate is good, your external debt should come down a bit. So if you are trading around 14 cedis, 70 pesos to a dollar, if you convert your external debt, you have a higher figure compared to, say, when the cedi went to 10 cedis earlier this year. So in the second quarter, that's why we saw the cedi go down to 10 cedis. I reported here on the show, also Winston, we reported that the external debt, we were predicting at the time, based on the numbers, that it should go down by about 150 billion Ghana cedis. Yeah. And it went down by 150 billion Ghana cedis. So when your external debt, when your exchange rate drops from 14 cedis, 70 pesos to 10 cedis, give or take, you're going to see a drop in your total debt. And then when it rises again, which we saw in the third quarter, and we also did reports on that where Bloomberg said in the third quarter the cedi was the worst performing currency, and then that also brought
some controversy.
So in the third quarter, that's where remember that the cedi went to 12 cedis. It rose up from 10 to 12
so
in
almost 13 at a point. Right?
Almost 13 at a point. Yeah. In just I think 4 weeks or so, it went up from 10 to 12 cedis. And just that 2 cedis made its impact. And if you break down the numbers a bit, you see that in the third quarter, that's from July to September, the actual debts added on is just about 10 billion Ghana cedis. So from the external side, we rigged in about $400 million in loans.
As fresh loans.
As fresh loans. $400 million in the third quarter as fresh loans. And if you convert it during the 12 cedis exchange rate, you will get about 4.9 billion Ghana cedis, give or take. And then for the domestic side, that's mainly the treasury bill market. We also added on debt in the third quarter by another 4.5, give or take, cedis, sorry. So if you have
about 5 billion around that time.
About 5 billion. So if you have 5 billion adding on to your domestic debt, and you have another almost 5 billion from the external side, that's about $10 billion in fresh debt. So in the third quarter, Ghana's debt increased by 10 billion due to addition. 10 billion cedis due to addition.
Yeah.
But then we are seeing 71 because of the exchange rate. In the third quarter, like I already mentioned, the cedi rose from, or the cedi depreciated from 10 to 12. So when you are converting your total debt, use the 12, not the 10. And then when you do all the math, the exchange rate effect on it is about 60 billion Ghana cedis.
That's huge.
The debt went up by 60 billion Ghana cedis. And people are saying that, well, the exchange rate, so it doesn't really matter.
Yeah.
But it matters because once the central government is going to pay some of this debt, they take cedis to the central bank converts it to dollars, and the government pays the debt. So if the exchange rate is favorable, you're taking less cedis away to go and pay your debt. And once you take less cedis away, the government has more cedis left behind for its projects and all of that. Because earlier this year too, when the central government managed to reduce the interest rates on T-bills, there was savings from that side. And the government transferred the savings to other parts of the economy. So exchange rate plays a major part in how much you're going to pay as your debt. So even though it's not the 70 billion, it's not the entire accumulation of debt, but 10 billion from fresh debt and about 60 billion from the exchange rate factor. So this is why we are seeing the same thing.
And in fact, I really remember on this show, we analyzing how the exchange rate situation actually forced the previous administration to seek the IMF support, right? Because once your balance of payments begins to deteriorate and you need more dollars, you need more cedis to actually get fewer dollars, you find yourself in this trouble. And I remember yesterday, we had a conversation with Professor Bokpin on AM show, who was actually saying that, well, this possibly might be majoring on the minor because we have fiscal space.
Yeah.
But we all know how that big fiscal space we have, possibly because of the debt restructuring we have done and the kind of discipline this government has actually put itself in. We all know how a small shift in the exchange rate could actually close this, fiscal gap that we have, the breathing space we have. Because within just about 3 months, with about 20% give or take depreciation of the cedi, we are racking up almost about 72 billion cedis in addition to our debt. And I remember Ken Oforiatta, when he was reading the 2023 budget, made mention that if you look at 2022, for instance, the country added about 92 billion cedis to its debt, not because it was borrowing, but because the exchange rate situation had deteriorated. And in fact, if you actually do some bit of analysis of our debt stock at the moment, you will see that a significant component of that is because of exchange rate fluctuation. If the exchange rate should move from $1 to about 9 cedis, trust me, without the government doing anything, it is going to reduce our debt stock from the current 684 billion cedis to about, let's say, 400 or 300 billion Ghana cedis. So it tells you that how you manage your exchange rate is actually a big determinant to your debt to GDP ratio, because your GDP is measured in cedis. And when you are doing the division, you are dividing it by the cedi, debt equivalent. And so you might have your GDP growing, but if your exchange rate situation is deteriorating, your GDP can be expanding by about 6%, 7%. But if your exchange rate is in a good situation, you may see your debts going up or racking up as well. If you look at the debt situation, where we started the first quarter of this year with a debt stock of about 769 billion, Ghana cedis. Now, because of the significant, improvement we saw the cedi actually, enjoying the second quarter, that debt alone decreased by about 150 billion. I remember we projected that. We wrote that there's an online story that was projecting that our debt situation could fall by more than 100 billion if the cities should follow that same trajectory. But it did in the second quarter. But in the third quarter, you have painted a picture. This is where that 71 billion we are talking about is coming from. Not significantly because government has borrowed, which you've explained that about 10 billion is coming from fresh loans. But the significant part of this 71 billion we are seeing is simply because of the exchange rate situation. And that brings us to how the Bank of Ghana has played an important role by indirectly influencing the debt stock, right? Because once the Bank of Ghana comes in to do the forex intervention, the expectation is that the cedi will do well. And when the cedi is doing well against major trading currencies, especially the dollar, then by not doing anything, you can actually have your debt situation going down. And in fact, many have said that when the debt actually reduced from 150 billion by 150 billion cedis, it was, it gave government that free space to now go to the market to borrow. Because we saw how government was tight, how they were not really borrowing so much from the T-bill market. They had even reduced their rates and all of that. But in the third quarter, although the exchange rate situation wasn't really good, they had that kind of breathing space from the second quarter to actually absorb the debt you spoke about. And so how you treat your exchange rate plays a major an important role in how your debt stock will actually fare. Let's now talk about the injections we have seen this year. And we will be doing some sort of analysis. We'll be publishing a story by next week to see how injections this year have affected the debt stock and the exchange rate situation as well. But how has that really affected it? We understand it's from the exchange rate, but there are a lot of people who get a bit confused when we talk about the injections. How is the injection even affecting the health of the cedi for it to even translate into the current debt we are seeing?
So the BOG will not be happy with the word injection.
It's injections.
It's
anyway.
injection, but they insist on intermediation.
Call it. It's an injection.
But then we know for a fact that this year, $10 billion have been put onto the market for market players to absorb. If you call that intermediation or interjection, you've still put $10 billion on the market. And once you put that amount of dollars in the market, now we start to talk about stability. Because if you talk about, and I just saw the provisional data for October with our current debt stock. And in October, you realize, if you remember, in October too, the cedi performed very well. So after peaking at 12 cedis in September, it dropped back to 10 cedis in October. And now it's around 11 cedis going up. But
that would definitely affect the debt stock.
So the provisional data from the Ministry of Finance shows that our debt stock reduced by 57 billion Ghana cedis in October alone. So from September, we increased it by 70 billion. In just 1 month, we've reduced it by 50 billion Ghana cedis. And this again,
we still have about 20 billion to actually write off through exchange rates performance.
And this again is because of your cedi. So now the question is, because you don't pay your entire debt stock as one, because they have different maturity dates, if you cannot keep the value of your cedi stable throughout that period, it means that it gets to a point where you have to pay your debt, and that month the cedi might actually go up, and you have to pay more debt, and then the following month might go down. So it depends on the balance between the central government and the BOG. If they are deliberate about certain months where the value of the cedi can come down, and then they pay less debt, so can come up, and they pay less debt and debt service obligations. Or then in other months where you don't have to pay so much debt, you let the cedi free float, and then and the market forces determine the value of the cedi. But then once that happens, it depends on how much you are giving to take. So if you are spending too much to prop up the value of the cedi or to strengthen the value of the currency, that in itself is an expense because the BOG has to spend. The BOG has to spend, put some dollars on the markets, which otherwise could have gone to the BOG's reserves. So once you are doing that, it's two sides. Either you put too much in the markets in dollar interventions to bring down the value of the currency, or you leave it and then the central government pays more in debt obligations. So it's about finding the balance between the central government and the BOG.
Now, because you have seen the provisional data for our debt in October, I want us to do this analysis. Just look at the amount of dollars that the BOG has made available in the market. 10 billion.
And we understand December.
We understand this a significant component of this went into, the forex markets, right? Now, this $10 billion, if we should use an exchange rate of, let's say, about, 10 cedis, 25 pesos, 10 cedis, 50 pesos, that's about 150 billion cedis, right? Now, that 150 billion cedis, just look at the net situation. Currently, where in the first quarter, just look at how much the first and second quarter, how much the debt actually fell. It fell by an equivalent of 150 billion cedis. So it was an important point you made that no matter how we look at it, it's an expense, right?
An expense,
Somebody has to pay for whatever we see the outlook of our debt situation, no matter what happens to it, whether it is going up or going down, somebody is at one end paying, where how much you make available to the market in terms of forex actually has a direct impact on how your exchange rate situation or on how your debt situation or your debt outlook will also perform. Because we have seen this. Just look at the external side of the debt, where significant burden is coming from. Out of that 71.6 billion cedis we are talking about 67 billion came from the external side, right? And we're trying to even look at the external debt in dollar terms. And what we saw was that if you compare its status in January to September, the external part of the debt stock had gone up by some 1.3 billion US dollars. Yeah. And we understand the World Bank facility we got was a big component.
The IMF,
and
some bilateral loans. Yeah.
Bilateral loans, and some of the reprofiling through the restructuring we did also played a significant role in that debt going up. Now, you made an important point, where next year, the moratorium we got from our bilateral creditors is going to end by May, if my memory serves me right. If the moratorium is going to end in May, how you treat the cedi or how the cedi performs in the first quarter will depict how much you pay as your debt when the moratorium at the bilateral side goes away and you are, asked to settle your debt, start repayment of your debt, because the nature of the restructuring we did was that it was more or less like the postponement of your pain to other years, where from 2026 next year, 2027 and 2028, we are going to revert to our normal status where we used to service our debt. Yeah. And in that case, you ask yourself, how will the Bank of Ghana find a balance between supporting the market and then also meeting the demands from the government to also settle debt? Because your bilateral moratorium is ending. Some of your principals are due very soon.
You have
start
payments to next year.
Exactly. How do we find this balance where the Bank of Ghana is going to wear a double hat here? How does it support the market, and how does it step in to help the government? Because remember that the governor said, or the explanation we are getting now, well, don't think that the 10 billion cedis, everything went into support the cedi. Yeah. Remember that there were IPPs we had to pay.
And IPPs, they take their money from ECG.
Exactly.
ECG gets their revenue in cedis.
So where did they get the dollars from?
The BOG.
So finding the balance is important. Yeah. And this is the reason why when we are talking about the debt situation and how that is the exchange rate is impacting the debt situation, that's the reason why it's important. So the question is, how do you find the balance by making sure that both sides of the coin have enough?
I think it's just about your coordination with the fiscal side, as government or the finance ministry, and the BOG. Because you don't want too much pressure to be on one side. So if the BOG is taking too much pressure in controlling the currency and allowing the central government enough space to pay some of the debt off cheaply in cedi terms, but because the dollar term is very stable, and then use the excess to finance other parts of the budget. So it's about finding the balance between supporting the government through the exchange rate situation and then allowing the government some fiscal space to embark on the projects. But then the main thing is that this 10 billion, we are seeing this because of two main factors. The gold price, and because of now gold board and how gold board operates.
Exactly.
And we'll get into gold board compensation very later on. But then, if we can guarantee that the price of gold is going to stay up for a very long time.
I like that word, that conditional statement, if we can guarantee. Very, very important.
Because
right?
This is a very volatile market. We've seen instances where gold prices have tanked before. It happened, I think, somewhere in 2013, gold prices came down from about almost $2,000 down to let's say about $1,000. So gold prices fall. They have fallen before. Even this year, they've fallen for some time.
Same with oil. Remember in 2013, 2014, 2015, when we had to go to Senchi, where the finance minister at that point in time said TechPay had to assemble people in Senchi to find ways and means to solve that economic problem we had. We eventually went to the IMF 2014, 2015. Around that time, we are dependent on oil.
Yeah. So if you focus too much on a commodity, you're exposing yourself up when the price of the commodity comes down. But then the government is banking their hopes on the forecast, because so far, almost every market analyst is estimating that or forecasting that gold price will stay high for at least the next 2 years. At least the next 2 years. And currently it's about $4,000, the highest it's ever been. So this is why the BOG is able to get so much dollars. Because one, the government now has entire control over the small-scale gold sector, where Gold Board buys everything with advance from the BOG. Gold Board sells it, gives all the dollars back to the BOG, and the BOG supports the markets through the commercial banks and then sometimes the government and all of that. So because of the price of gold and how now government has their full control over the small-scale gold sector, this is why the economy is reckoning so much forex at the moment.
And you spoke about the midpoint, where both sides of the management have to meet at the midpoint, where the monetary side and the fiscal side must meet.
Yeah.
And I must say that for the first time in a long time, we are seeing some level of synergy between the fiscal guys and the monetary guys. There is that connection there. I'm not really seeing the detachedness where you have the monetary side doing their own thing, the fiscal guys also doing their own thing. And in fact, one thing that is also helping this government is their fiscal prudence, where, if you look at the revenue this year, for instance, we understand fell significantly. Exactly, and instead of maybe, we know hitherto government would have just come to the market, borrow heavily, increase the T-bill rate, borrow, and to fund that expenditure. What we are also seeing is that government is beginning to cut expenditure to meet that fall in revenue, right? Now, the key question you need to ask yourself is that whose expenditure are you even cutting to make sure that you meet this fiscal discipline, right? So it's an important question we need to ask, because we've heard complain that some monies are not going through. People say that government is not spending, and it's not government's fault that it's not spending. It's simply because they are at a tight situation where you have your revenues not coming in simply because, one, of the same exchange rate situation.
From there fell heavily.
Exactly.
And even though the finance minister blamed it on some officials' reports, we have to admit that because of the exchange rate, they're going to lose some revenue.
The exchange rate situation really affected import revenue. And if you go on the other tangent, talking about other revenue handles, it's simply because government decided to forgo some 3.5 billion from, not totally from COVID-19 levy, but the COVID-19 levy they've been collecting this year.
Yeah,
It's just next year that it will not start coming. But that money or the amount they actually forwent under the e-levy and other levies like the betting tax and other things that they had to restructure really affected government. And I remember the finance minister preferred some solution around at that time here on JoyNews on PM Express saying that, well, they are looking at the tax refund account.
Yeah.
How far with that? Nobody actually knows. And how is that even helping the government to close the gap? Because this government has a lot of commitments. You are cutting, revenue, and on the other side, there's a lot of pressure on you to spend because you've promised a big push initiative. You've promised so many things, the 24-hour economy, which many are saying that they're not really seeing. It's being rolled out the way they were expecting. All of these are huge expenditure, burdens on government. But the key word is, how do you find that midpoint where the fiscal side, their discipline meets that stringent monetary policy or, strategic monetary policy we are seeing currently, where at the moment you ask yourself, how is the Bank of Ghana getting that kind of monetary muscle to come in and cut policy rate by more than 1,000 basis points? Because there are lots who are saying that, well, this is the first time in the history of the city, in a very long time, that you are seeing a lot of pressure in the last quarter. Usually the last quarter we've analyzed here is a quarter that gets the lifeline, right? But this year we are beginning to see some, undulating movement, some oscillations in the fourth quarter because BOG did some level of intervention. But it's also clear that demand is picking up. And why? Because you now have banks who are reducing their rates from the high levels of 30 to about 21 to 22 in terms of the cost of borrowing, interest rate. Now, the key question is, if you have interest rates coming down, how sure are you, and you keep cutting policy rates by 1,000 basis points cumulatively in the whole year, how sure are you that people are not going to the banks to get the capital and chase dollars in the system to create some of this pressure? So I understand the Bank of Ghana when they are going very hard and high on compliance. Yeah. Just yesterday we saw a new document coming about regulation, and you see that the Bank of Ghana is taking a different twist where they are not only coming in to do intervention, but they are making sure that they are blocking every loophole that could cause undue pressure on the available dollars in the system. But the key question is, as you begin to block those loopholes, day in and day out, people try to find ways and means to go around the system. How far can we use strategic, regulations to make sure that the kind of demand we've created because of the cuts in the monetary policy rate doesn't affect exchange rate for it to even affect this situation?
I think one of the policy tools the BOG is using to do that is with this new intermediation policy, as they call it.
Yeah.
Because earlier this year, when the cedi started depreciating rapidly from the 10 to 12, we were predicting that because the BOG had reduced intervention in markets. And then if you look at the time, that was around September, the BOG told the IMF that in September, at the end of September, they'll come out with a policy document to regulate how they will enter the markets. And then we now have indication from the BOG that they have rolled out that policy. And if you look at the policy, it's all about, according to the BOG, it's about meeting the market demand.
Yeah.
So they're only bringing dollars to the markets that they sense
strategic sectors.
They sense that the markets will be able to absorb. So in December, the BOG announced $800 million. When they started announcing, it was above $1 billion. December is the lowest, which means that the BOG, doing this market analysis, saw that the demand for December is going to be a bit lower.
Yeah.
But then it also coincidental that the lowest that you've announced so far, that's the $800 million, is when we are seeing pressure on the currency.
Yeah.
Because in the past few weeks, it's been depreciating from 10, now 11.4, 11.45, I think 11.5 currently. So it's all about managing the demand, supply, and then speaking and liaising with the fiscal authorities.
But it's expected, Caleb. I mean, if you cut policy rate by 300 basis points, and in 2 quarters, you cut by some 700 basis points. The expectation, if you do the math, is that maybe historically, demand for December may not be that high. But if you cut the rates and banks follow up with a lower interest rate, mind you, there will be people who will go to the banks to pick up capital, to pick up loans, and increase the demand.
But on the other side of the coin is that the BOG has been aggressively mopping up liquidity on the market. So even though they are reducing the policy rates, if you look at the the market supply, the trend of market supply, the increase in the money supply, because when your money supply is high in the market, it's going to be inflation and all of that. So if you look at the trend of market supply into the economy, it's been very low.
Very tight.
There was a point where it grew by, it contracted, so it was negative for a certain month. So one of the BOG is doing this, reducing money supply through their repos and all of that, and then they are reducing the policy rates. They're trying to channel where the money should go. And also, before you can access dollars, the BOG is now very strict.
Yeah, documentation.
We had the importers complain that they cannot access dollars as easily as before. And now again, the BOG is, clamping down on their bushes. They arrested some of them recently. So it's all about managing the supply.
Yeah. So I think that the most important thing we need to end this conversation on is management and finding the balance, right? That midpoint to make sure that, well, the BOG has enough to meet the markets and then also have enough to make sure that that government doesn't find itself under a lot of pressure. And so this is the breakdown for you. So if you're seeing that 71 billion or 71.6 billion increase in the debt stock, significantly, that was because of the exchange rate situation. But we also understand that there was some borrowing that was done in the 3rd quarter. Why? Because government had that fiscal space to come to the market to pick up some monies to help the economy. And so finding that balance is very important. And this has been Beyond the Numbers with me, Isaac Kofi, and I did this with
Caleb Zebulon.
See you on Friday.